Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. I'm like way behind today. I don't really know why. I forgot to make the stream last night. Oh geez, like I'm super off because I don't even have Spotify open so that we can have some background music. What is wrong? What is wrong with me, guys? Man. Hold on a second. Hold on, where's Spotify? Come on. Come on. Yeah, you can do it. Spotify is too heavy of an app. Maybe I need to go find an alternative. Okay. So hey, we're about to get some numbers, but they're just like international trade numbers. Not really a big deal. So let's come over, check out the charts. Okay, so yesterday in the treasuries, a pretty decent move down. Most of that move happened before our trading session. There was a little bit further leg down. Now, interesting thing on this one though is that it was very much flattening. So if we come back over here to the ZB, you'll see that they did not make new lows after the morning session. But the 10-year and the 5-year did. So there's not like a ton of spread between. Well, you can see it right there, right? Flattening. But overnight, it's been relatively quiet. Okay, S&P 500 also actually really flat yesterday. Interesting. Oil continuing its recovery. Natural gas still kind of down in the dumps. Silver and gold ranging after getting destroyed last Friday. Copper still on the downtrend. Copper, come on. Well, maybe we're getting a good opportunity in copper. I don't know. And here's the dollar. The dollar continues to trudge higher, pushing 103.61. Will they hit 104? Kind of seems like they could. Bitcoin flat after taking a little bit of a drop. I do kind of wonder if they don't come back down to like the 2100 area. That's basically where we find ourselves this morning. Come back over here. So today we have Chairman Powell speaking. It's much later in the day though. It's like at 1. It's like 3 o'clock Eastern time or something like that. Where is it? We have a 3-year no auction. Oh, it's at 10 o'clock. It's at 12 o'clock Eastern time, 10 o'clock my time. So yeah, and then after that, an hour after that, we have 3-year note auction. That's gonna be a little bit interesting. So yeah, this is basically the situation that we find ourselves. Now, what is the event? So the event is going to be, he's speaking at the, I think it's the Economic Club of Washington, D.C. So it's going to be the similar format to the Brookings Institute, where there is a moderator who is a known media personality. This is a guy I'm not too familiar with, but and he's going to interview Powell. So it is a situation where Powell will have a lot of opportunity to say something and churn the markets. So I think that the treasuries will probably continue to trade today, but you know, their action is going to be a little bit constrained compared to days past as the market awaits Powell. But you can see here the treasuries are not really like backing off so much. Okay. But like, look, like they're pushing down, but like it's not a ton of volume right now. Okay. So that might limit our opportunities today, but let's see what happens. Now, somebody was asking about an indicator. So let me go. I want to find this indicator. I think it was it a sit? No, was it Poncho? Yeah, it was Poncho's. I think I'm just gonna go find the download. Looks like it has a newer version of it. Okay. Let's get that out of the way. I do have some food here. You guys are awfully quiet. I am live, right? I don't know. I think we're live. We got viewers, so we're good. I did. Yeah. I might still want to mess around with the vertical bit. Oh, look, they're pushing here again. Let's reset our DOM. I don't know if I want to just ignore this one. I'll keep an eye on it, but I will take a couple of bites here. I think now is a good point to do that. Well, so far, it's been a few minutes now. They've made one tick further progress here in the Treasury. There actually is some volume hitting at 11.5. I mean, it's only 1,400 contracts, but that's a lot more than what was being traded before. But it looks like it's going to tick back up. So I wouldn't necessarily call this absorption per se, but it does look like the market orders are kind of already sputtering out. Well, it seems that the selling is more concentrated in the 30-year. I wouldn't say that the amount of volume that's going through the 30-year is heavier, but the balance of the flows is going through are more tilted to the downside on these other ones. And so you've got the 30-year down 2 ticks and the 5-year flat, if not up 1 tick. So a little bit of steepening there off of this move as we kind of range around in this area. Oh yeah, Powell speaking. So the event that Powell is speaking at today is very similar to the event that he spoke at the end of November at the Brookings Institute that really strongly moved the markets and kind of triggered a rally. So I would be placing the same kind of risk premium on today as that. That's what I would be using as my blueprint. Well, for us in the treasury market, I don't know if we necessarily need a catalyst per se. I think that at least the current, it's not always like this, but I think that at the current time, the auctions themselves are an interesting enough event in the treasuries to create movement. So let's see. I'll put this up here real quick. Wow, Fannie Mae survey, only 17% of respondents believe it's a good time to buy. That's crazy. Treasury is up now towards the mid of the range. The CFT, I'm not sure who you're referring to. We can talk about the bonds real quickly here in a second. Let me finish eating here. Okay, so Joe says thoughts on ES. I think that trading is going to be really difficult today. Up until Powell speaks at 10 o'clock. So again, if you're not aware, Jerome Powell will be speaking at 12 o'clock Eastern time, 10 o'clock my time. This event is similar to the Brookings event that happened at the end of November and triggered a large market rally. So it is an event with a large risk premium attached to it. The options are all pricing in large volatility and all that. Okay. So trade in the S&P 500 might be a little bit choppy before then, but we'll see. I don't know what you think he's going to do. You know, like, I really thought he would be more hawkish his last Federal Reserve meeting. Does that mean that he's likely to continue this dovish tilt, or do you think that the jobs numbers will change his mind? I don't know. Volatility nightmare, yeah. I think I didn't really read the story, but Zero Hedge was talking about a delta squeeze. So, okay, so bonds. So I do have a video about the bond market, but you kind of asked a specific question about lower prices, higher yields. So a bond is a security, and it's really the simplest type of security you can get, really. So when you buy a stock, right, you're buying an ownership of the company, and you're buying, and it also, you know, you can also receive dividends from it, right? So when people are pricing out stocks, they try and sort out, okay, what will the future dividends from this stock be, and as such, what it's worth. And based off of all of that stuff, you get basically a discount factor, right? And that's pricing stocks. So pricing stocks is incredibly complicated because there's that whole bit of what are the future earnings of that company going to be. Okay. Bond removes all of that question from the equation, because a bond is simply issuer issues a bond, and then the holder of that bond will receive regular interest payments. Okay. For the bonds that we trade, the treasuries, it's basically you get a coupon payment every 6 months. Okay. Which is, by the way, why the inflation target is 2%, right? So you get two interest payments per year of 1%. Easy math. Okay. So the whole thing is like, the higher the yield is that I'm offering, right? The more that people are going to want my bond, right? So this is kind of the balancing act for it. Is if we're at auction, okay, and I have $1 billion worth of bonds to auction off, and I say, okay, the yield is going to be, you know, whatever the current yield on the treasury is. So I'm going to say the yield is going to be 3.64. Okay. And then people in the market don't only want to buy like half of them. You know, I want to offer $1 billion and they only bought 500 million of them. Then what do? Well, in order to entice more people to buy, I'm going to have to raise the interest rate. Right. So, basically, there's like this inverse relationship between bond yields and bond prices. They're not like perfectly symmetrical per se, because you can get situations where prices move more than the yields and vice versa. But pretty much they're mirrors of each other. Okay. So when you see the treasuries moving down, what you should be thinking is, okay, price is moving down. That means that the yields are going to get more attractive, right? And it basically keeps going further and further and further until you get to the point where it is like right now, where a lot of funds really just can't pass up on it, right? So like a lot of pension funds, because of the way that they invest, they make money when the bonds go up, and it basically means that they don't have to make as much. They're overfunded more than what they need to pay for the employees. So they're going to look at this and say, well, heck, I can take this 10% of my money that I don't need and just put it into bonds and get a guaranteed 3.641. So I can basically reduce my risk to practically nothing and still accomplish all of my goals. Why am I not going to do that, right? And there comes a point where it's like, another thing was, oh my gosh, this made me so mad, actually. So yesterday I came across a TikTok where they were like, General Mills made $200 million in profit, and or they paid a $200 million dividend. Like, how is it that they can be making so much money at our expense, yada 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 yada, all this stuff, right? And I go and I look at it, and like, what is the dividend yield that they're talking about? It's like 2%. So like, think about that. Think about that for a second. You're gonna own this stock, you have all of the risk involved with owning a stock, and the dividend that you get is less than the dividend that you're gonna get on the treasuries. Why wouldn't you just buy the treasuries? Like, you should be grateful that there are people out there willing to invest in food, or we wouldn't have anything to eat. And people are trying to demonize them when the profits that they made are not very good looking at all, you know? Oh, it frustrates me so much. There's so many people out there. I wonder if it's all just a Chinese disinformation op. Like, seriously, because I get so much anti-capitalism kind of content on TikTok. So much. It's crazy. And it's almost always based on just blatant misinformation. Everything is a Ponzi. Yeah. So this is another one that really bothers me. Not everything is a Ponzi. So what makes it a Ponzi? What makes it a Ponzi? Okay. Well, so what we really need to do is we need to get back to the heart of what is a security. Okay. So this is I'm going to take a different approach from this. Okay. Let me try. Let me try to take a different approach of this. Okay. Because I think, let me take a different approach, because I think that this could, what is the word I'm looking for? Let's talk about what a security is, because I think that this might have some interesting implications for the Bitcoin folks that they may not like. So what is a security? A security is you buying something to invest in a common enterprise with the expectation of profits that are made solely from the efforts of other people. So Bitcoin, they argue that Bitcoin is not a security. So why is that? Well, because you don't have expectation of profits based on a common enterprise. Okay. Well, so what that means is it's a Ponzi scheme, right? Because that's the difference between a security and a Ponzi, is that there's an actual business underneath of it that is generating income, that is bringing in revenue streams, right? So yeah, a cryptocurrency is based purely on, greater fool theory. Somebody else is going to come along and invest in it. Totally. So that's a really key point. So a lot of people are coming in and they're saying, well, it's a Ponzi. So why are they saying it's a Ponzi? Why? Yeah, no real yield. We are the yield. Maybe I should just be recording all of this. So a lot of people will say, like, everything is a Ponzi. Well, okay, first of all, from the definition, okay, it's not a Ponzi, because if there's an actual underlying business, it's not a Ponzi. But why do people say that? Well, because if you come in and you buy something, that has a tendency to make the price go up. So really what people are trying to say is that it is blatantly obvious to everybody paying attention now that markets are not actually informationally efficient. They think that the value of the business should be this based on everything that we know about it, but instead it's this. And why is it this? Because people are buying it for no good reason, right? The value of Bed Bath & Beyond should be zero. That company is being sold off into bankruptcy. And they go and they do a rights offering. They say, we might not even actually receive any of this money. It's just going to go to pay off debts and everything. and everybody buys it. Like what the heck? How can people be so dumb? But like it happens, and it keeps happening these days. And the people that put their money into that, they just lose the money. It's insane, right? But why does it happen? Because your orders, your transactions in the stock market have impact and will move price, because prices in a financial market are extremely inelastic. One big player coming in and trying to buy a large amount of something really significantly moves price. Okay, that doesn't make it a Ponzi though. The key thing about a Ponzi is that there is an underlying business there. Okay, that's really important. Okay, because at the end of the day, all of this other stuff could fall apart and people could sell the stock off and everything. But as long as there's an underlying business there that is generating cash flows, the stock still has value, right? So this is why I hate it when people say the whole stock market is a Ponzi. Okay, well, but with all that in mind, let's not dismiss some of the important implications from all of this, right? Because if your orders have impact, what will happen to the stock market when you get to a place where more retirees are pulling money out than new workers are putting money in? That's a big problem. You're probably going to see the stock market decline, and it will be very devastating for the wealth of this country if we ever get in that situation. Yes, but it's not a Ponzi, because there's still an underlying business. If you sold me all the Bitcoin for 25, well, yeah, I like the argument that Warren Buffett makes on that one, right? So land always has use. You can always do something with it. Businesses generate cash flow. Bitcoin only has worth in as much as other people have Bitcoin, right? But that's kind of interesting. I mean, I could make the same thing. I could make the same argument for the dollar, right? If I owned every dollar in existence and nobody else used dollars anymore, then dollars wouldn't be worth anything, would they? That's why when you're investing, you want to have a business. You don't want to just own currencies. It's just trading. So I recorded that. I'll probably try and turn that into some sort of a video at some point. I could maybe just go further recording the full thing. What the issue that I have is like, I want to turn them into TikToks. I think that the right thing to do is just to record it in a TikTok format. That makes it a lot easier for me to like edit. Because if I try and record out the whole stream, then it's like I still have to like edit it and everything, right? It was better when I could like record the screen and myself though in like two separate things. I got to figure out how to fix that. What's this from News Squawk? Useful overview of the change in... Okay, so the blue is the current implied rate. The FOMC is the post-FOMC implied rate. And the gray is the January 01 implied rate. Oh, and they're using the futures to say this is what they are currently pricing. That the post FOMC implied rate is lower than the implied rate right now. So we after that non-farms, expectations for peak interest rates like really spiked up and went well above 5%, and started to go out further with them saying, oh, you know, maybe they will hike rates into the summer. I like it. Tell me you're committed without telling me you're committed. And it has a guy, he is in his car with a laptop because he has to go to class, trading before class. And you know what? If you're a kid, I was thinking about this today. Dude, my new book came. Okay. This is why I was thinking about this. So I was kind of already reading it a little bit because I had like a digital version of it, but I really like just having, maybe it's just for bragging rights, I don't know, but I really like having the physical book in my hand, and I like having a bookcase behind me with lots of useful books on it. I'm really impressed with the book that they gave me. Like this one, I wish I could get this one in hardback. This one, low latency interest rate models. Maybe I should pay somebody to bind it for me. That would be cool. Make it like leather bound. That'd be dope. If I was a billionaire, that's what I would do. I would pay some artist money to make all of my books leatherback. But man, this one is a thick boy. I mean, I guess it's about the same thickness as the other ones, and it is like a smaller in profile than some of my other ones. But there's just something hefty feeling about this thing. And when you get into it, you can open up almost any page, and you're gonna see like hardcore math in it. So I'm excited about this book. And the first thought is, well, how am I going to read such a involved book? When I was reading the stuff where I learned a lot about market microstructure, you know, I was able to just sit and read through that. This book, you know, there's like examples and you know, like I'm going to have to sit at my computer and do it. Like it's going to be a lot of time to get through that book, a lot of dedication, and this is going to be hard to find the time. And, you know, this gets back to, I don't want to stop trading, but sometimes I do really wish that I could use this time to study my books and stuff instead, you know? So if I was a college student, you know, I think that instead of trying to trade, I would be more focused on doing the studying because as a college student, if you can get in to a big firm, you know, you'll have plenty of time to trade. You know what I mean? So it seems to me like as you're younger, the more information you can cram in, the better. You might want to err on the side of gathering more knowledge about the market rather than direct experience from the trading. Of course, you could do both, but you know, I'm kind of in a unique situation because if it was like a normal day, or if I was like a normal trader, I might just say, well, because Powell's speaking today, I don't know if there's going to be good opportunities for me. Maybe I should just study and not watch the market, right? Wish you could do that. You missed it. What was the book? What did you miss? The book? The book is Machine Learning in Finance. Machine Learning in Finance by Matthew F. Dixon and Igor Halperin. There is another book about machine learning with finance, but these two guys are, oh my gosh. I've got both of them on my LinkedIn feed because I wanted to read this book. And Igor Halperin works for Fidelity, I believe it is. And he posts such good stuff on LinkedIn. Such good stuff. You find him on LinkedIn. He's a good guy to follow. I really like him. maybe when I see these, you know, when I start going through these names, like one of the things that's exciting for me is like someday maybe I actually will meet some of these guys. So that's cool. And man, writing a book like that must be so effing hard. Yeah, machine learning in finance. Okay, I just find it. I'm just gonna link you. This book. So these guys have won multiple awards for being like quant of the year and stuff. Like this is top stuff. This is like it kind of bothers me that in the retail trading community that everybody focuses on like the Jack Swagger books, you know, because I haven't read through all of those, but from what I've seen so far, there's a lot of people that probably got lucky or strategies that don't work anymore, right? Because they're just kind of like some Yahoo that you know happened to make money in the stock market, versus the people that are truly the most respected names in the field in their particular subject, in this case machine learning. And like most retail traders don't know who they are, or that you can follow them on LinkedIn. You know, it's like, it's mind-blowing, right? There's a real disconnect between what retail traders tend to look for education and what they should be looking for education, right? Find it. You want to do like a real education, find a book with lots of math in it. Should be difficult material for you to get through. It shouldn't be material that you just casually read, right? It's going to be something that you have to sit down at a desk, maybe have some paper out, maybe have to program some things. That's real research. I don't wonder, maybe we'll try it tomorrow. I thought that the flashback recording, nah, actually I don't want to do that. I don't know how I want to do this. I just need to get the source record to work. This is what I need to do. We could try it again, and maybe towards the end of the stream we'll try it again. I really want to get that source record one working. Maybe if I just choose a different encoder. I don't know why I get different encoders for it. Those different encoders might not even... I'm so tempted to just try it right now. I'm not going to do it. I want to stop the stream right now. I'm all like, oh, I want to record this stuff so I can make like TikTok videos out of it, but then I'm probably not going to actually turn them into TikTok videos. So the issue is then going in and finding the content is too hard. Let's see here. France's Finance Minister Le Maire, we must make sure that as many European nations as possible are included in the framework of the U.S. Inflation Reduction Act. I think that they're talking about there are like some provisions in that act that kind of affect trade. and the European nations are uneasy about it, let's say. More stuff about Binance. So apparently people haven't been able to like convert their coins into dollars at Binance right now because they're basically their access to banks got cut off. Although they appear to be kind of trying to avoid saying that. Oh, you know what? There was one other thing that I wanted to do here. Yes, let's see if I can find it. There was somebody was asking, I will trade your strategies on algo trading. Well, I can't find it. Maybe it got deleted or something. I don't know. It's weird. Somebody yesterday commented on an older video about you're probably not going to make a successful algorithm with ChatGPT. And they're like, so all of these algorithms that we're always hearing about, they don't make money. It's like, I don't think you realize the difference between those, right? So I think what I need to do for this, guys, we need to go into, okay, like what kind of works and what doesn't work, right? So if you come into a single time price series, you say the price Y is equal to some function, f of t, right? That's function at time t, okay? If you know what t minus 1 is, it doesn't tell you very much about what t is going to be, other than within the range of volatility, right? That's it. So those strategies based on a single time price series tend not to work. And that's what I would term technical analysis, because that's what you're doing. You're pulling up a single chart, and then using that one single chart, you're trying to make a prediction about what it's going to do based on what you think that the charts have a tendency to do, but don't actually do, right? So people will confuse technical analysis with systematic or quantitative trading, right? You can have a systematic or quantitative system without incorporating technical analysis. How do you do that? You have to have more data than the single time price series, is really what it comes down to, right? So if I know, for instance, if I have a data series that says this is what the current this is what the holdings of large index fund is right now, and we know that at the end of the month it needs to be this because it needs to be rebalanced, right? Now with that additional data series, which by the way kind of includes like future data to some extent, right? Now you can maybe make a prediction about where things are going to go, right? You have to bring in other data. Because analyzing one single time price series doesn't do shit. And that's why, so when you're looking at these algos that are making money, that's what they're doing. Okay, I don't know. What would be an example of a non-linear interest rate product? They talk about, so like, let me read to you the names of the chapters. Chapter 1, Introduction to Interest Rate Markets. Chapter 2, Introduction to Interest Rate Swaps. Chapter 3, Interest Rate Products and Pricing. So then they've got like overnight index swaps, risk-free rate swaps, tenor basis swaps, cross-currency swaps, credit default swaps, asset swaps, forward rate agreements, interest rate futures. nonlinear equals non-static DV01. I think it probably does go into this. Okay, so then the next thing is yield curves forecasting and discounting cash flows. Yeah, what would be a nonlinear? Interest rate futures must be either ED or SFR3 or RFRs. Okay. He talks a lot about in here about curve Jacobians, interest rate risk, credit models, interest rate swap pricing and risk, interest rate swap case study examples. Asset, oh, that page came out, was not bound very well. Asset swap structuring examples, trader pricing tricks and rules of thumb. Key pricing and risk factor, the annuity factor. I don't know. So I think to answer your question, I would have to read the whole book. Because it sounds to me like it does deal with non-linear information, although it kind of sounds like that would be like the that would be like the that's a risk factor that we have to account for, and how do we account for it, sort of a thing. Well, no, but they mentioned futures, for instance, right? Interest rate futures. Difference between futures and FRAs. Although I would say that based, because I've only read the introduction, okay, and I'm not going to read this book yet. I'm going to read the machine learning one first. It seems to me like this book is more about like, I mean, I think that this book is like, you read this book and you should be able to go and work on the programming section of an interest rate desk is what I think that the intention of this book is. So I don't think that the purpose of this book is like, here is a trading strategy that I'm gonna give you a blueprint for and all of that. I think it's more like, if you go to work on a bank in fixed income and commodities, that you'll have the background knowledge to accomplish the tasks that you need to use. So he's kind of giving you the general tools that you need to program that stuff and be able to program it fast. When interest rate futures are talked about as always, TERS or yield futures, not bond futures, thus ergo linear. But it sounds to me like what you're pointing out, though, the reason you're interested in it is because of where you'd have to get that data, right? Therefore, would you be able to take all of this stuff in this book and be able to program a live trading algorithm with it, right? That's what you're asking. And I think the answer is no. I think that what he does is he kind of gives you example data, and you know, there's spreadsheets and things like that. So it's going through all of the examples and stuff so that you can understand it to be able to do it for a job. But you probably would not have access to the live data to do all this stuff yourself, per se, if that's what you're asking. But we might be able to use some of that knowledge to apply it to the data that we do have, which is the treasury futures, right? Because the thing that I'm interested in particular is the whole like building a yield curve and discount rates and using that to kind of estimate what a particular security should be. That's the thing that kind of interests me. because I kind of know like generally how you would do that, and I think that if I went into a spreadsheet and like did it all out, I think that if you gave me like a month, I could probably figure it out. But I don't think that it would be very performant, right? So there's like a bunch of little tricks in here that he seems to hint at that would be beneficial to us. Yeah. It always does come down to better data though, doesn't it? Like that's the thing, is like individual time price series data for individual stocks is like really readily available now. You know why that is? Because it's not worth very much. There's not a whole lot of information that you can actually pull from it. Order flow information, you know, it costs $30 a month. Why is that? Well, because there is some informational content in it. It's very difficult to make money using just that informational content because there's like high competition for it, but there is actually like real information in there that you can use, right? You combine that with all the other sources that you can kind of tie together as a retail trader. Maybe you're able to piece together something that works, right? Man, the treasuries started out really interesting this morning. There was spreading and all this sort of stuff. But since then, it's just kind of died out. I don't know, Akshay. The bigger thing here is I think you would like this book. Just based on what I know about it so far. This book is like, okay, all of this stuff that you learn in Stigum and everything is like really interesting and useful information. But like, how do you actually put it into practice in programming something for it? And that's what this book is trying to do. So I'll be right back. I'm gonna get more water. What interest rate? Well, I don't think that they really go into, I don't think that the intention is to go into specifics about, okay, here is the SOFR. Well, actually, they do talk about automatic adjoint differentiation. There is adjoint move, a mode, and there is stuff about automatic differentiation. It sounds to me like yes, they do. Just looking at the appendix. So the first chapter of it is actually it might be boring to you. It might be stuff that you already kind of know. Introduction to interest rate markets, project finance, risk management, and hedge instrument, interest rate benchmarks, impact of benchmark interest rate reform, structural interest rate changes, fallback rates, yield curve changes, new interest rate products, market terminology, interest rate market changes. So, but I don't think that the book goes like, okay, if you're going to do SOFR futures, here's everything that you need to know about SOFR per se. I think that the idea is more to be like, here are the different kinds of tools that you need when working in the fixed space from the quantitative side. And they do talk about different asset types like swaps and so forth, but that's only in as much as so that you can understand the tools that work with them. They talk, well, they probably, I'm gonna bet they don't talk about like the specific ones. Futures, break-even rate, cash settlement, chains, contract colors, contract specifications, contract triggers, convexity adjustments, cost of carry, hedging, initial margin, LIBOR convexity adjustments, month codes, pricing, quotes, tickers, variation margin. But I don't think that he's going to tell you like the stylized behaviors of ZB, right? Oh, well, they do. He definitely does mention SOFRs, but what he's gonna actually tell us about them, I'm not sure. Sounds very introductory. Well, but that's the thing is, do you know? Oh, wait. You're saying it sounds very introductory. That's two separate thoughts, isn't it? You're saying it sounds very introductory, and then you're saying I don't care about the stylized behavior of ZV is what you're saying? I am. I am very much interested in is there a stylized behavior that is unique to this instrument? It seems to me that there are some, in particular with ZB. So I don't know why the deal is, but almost every kind of like, let's say, what do we call them? Indicator soup kind of strategy I've ever tried on ZB. It worked better on ZB than it did on ZN. Never found any of those that I really thought were tradable, but they always performed better on ZN than on ZB than on ZN. It was like ZB was more technical. Yeah, indicator soup is basically slang for you put a bunch of different indicators on a chart and then try and sort out some strategy from them. So it's meshing different technical analysis strategies together, or in my case, meshing like different order flow kind of things together, right? So when I would backtest like order flow stuff, always worked better on ZN, and when I would backtest more price-based things, it always worked better on ZB. And yeah, might be even better on UB. I usually didn't test that one. But so there's some sort of weird behavior that changes between them, and I'm not sure why, right? And there seems to be some stylized behaviors of spreads, like spreads do seem to have this mean reversion behavior, and like there's limits on how far it will go before that you'll see it people fight against it, and I'm not entirely sure what causes those. I mean, we have some idea of it, but not to the degree of which I could like write a study about it. You know what I mean? I got something on my mouse pad here. I don't know what happened. This is probably making the whole desk shake. But anyways, the thing is I think that like the low latency part is a key part of that book, right? Because what he's saying is you probably know how to price out a swap, for instance, right? But what he's saying is, here's how you do it really, really quickly so that you can be competitive in a automated strategy. I don't know where I read this, but some paper said the more volatile an instrument is, the more they tend to have positive results from momentum-based indicators like RSI. Yeah. And I think the one that I probably used the most was CCI. I have a version of CCI that I think it came from Euler, where the period that it uses adjusts dynamically based on the chart, and I've always found that to be effective. So like if I come in and I have a strategy that I think has some efficacy, let's just pick something random. Let's just say we're gonna pick a random, like, you know, a candlestick pattern or something like that, right? If I then add the adaptive CCI as a filter on that indicator, my performance always improves. So it seems like there is some efficacy to that indicator, which is the best I've seen in terms of like relative momentum, because that's kind of what CCI does for you. Is it kind of shows you how much trend and how fast of a trend is there now compared to before. Is the book the same one? Oh, probably. Go to site, because he did have stuff on SSRM. Yep, that is it. That is it. So, yeah. Oh, this is the one. If you go back and you look at him, like his name. Here, I'll pull you over here. So if you come on to SSRM and you just look up Nicholas here, right? He has like a bunch of papers, and basically what he did was he took these papers that he had written and kind of combined them into the book. So, but probably a lot of these things are things that you are already familiar with, right? So like, you know, if you already know how to do that and you're not necessarily interested in constructing a robot to do it, then it might not be interesting to you, right? But for somebody that's like new, it seems to me like this might be a good alternative to some of the classics, right? Because you get like the same kind of information about how you do the pricing and the key models that you need, but you kind of get practical application of it and code and stuff like that. But like I said, I don't think that's the one. Yeah, I was talking from my learning for someone completely new. It could be extremely beneficial. Yeah. You're interested in because I brought it up yesterday. You're like, maybe I should read that one. I don't know if that's the one that you should read. I am going to read this one first, though. Machine Learning in Finance. Because I want more information on how to use Markov decision-making processes and so forth to see if I can improve some of my indicators based on market depth pressure. So I'm hoping that incorporating some machine learning, but we'll see. Like the thing is I don't know enough about the machine learning and its application to know where the applications would be the most beneficial. So we're just gonna have to read it. I'm sure we're gonna learn lots of things. The ECB's Nagel speaking at the moment, talking about, what is it that he said here? ECB rates are not yet restrictive. What do I mean by market depth pressure? So if I come in here to my DOM and I say, based on the 10 inside, or maybe not even the 10, let's just say that the 4 most inside levels, what is the cumulative depth? And then my indicators, they try and do filtering and stuff. So they will look at the maximum and minimum of each price level during that time period and so forth, to try and filter out the robots that are randomly stacking and pulling to create noise and so forth, right? And what you'll get is kind of this balance, and what you're gonna find is that one side will have more limit orders than the other side. Almost always, there's almost always some sort of an imbalance, and when that imbalance shifts, you will start to see different behavior in the way that the instrument changes, right? But I wish that it was as simple as, okay, when you see that imbalance change, now you want to start taking longs or whatever the deal is. But what I found is that there appears to be some sort of regime switching mechanism behind it, which is to say that in some regimes, the market will always go towards the liquidity, and in other regimes, the market will always move away from the liquidity. And so the hope is that by incorporating some momentum effects, and maybe some metrics based on the market orders as well, and combining them into some sort of a Markov machine learning process, that it may be able to sort that system out so that you kind of are able to get a strategy that's a little more consistent. Because the way that the back tests were working before was it will work perfectly that week, and then the next week it will completely shift, and then the next week after that it'll go back to what it was, and it's how do you determine why does it switch between these modes, right? So we can use the machine learning to figure that out for us. And I remember, and part of it is that I remember some guys at the bank saying something about that there's a definite edge to what the book pressure is, but it was so complicated that they couldn't explain it to me, which now when I look back at it, I'm like, maybe they were trying to explain a Markov process to me. So that's why I'm interested in it. So we'll see what happens. in either event, I really think that, like, in terms of like my I mean, I have pretty extensive programming knowledge and so forth at this point, right? So I think that in order to really up my skills in a way that would be beneficial towards trying to program automated strategies and so forth, that machine learning is the next step that I need to take. So that's why that book comes first. The other book, maybe it gives us an idea, but I'm not sure. I'm kind of worried that I'll read that book and then I won't actually use any of it. Yeah, you can also use correlation with other assets to identify shifts like the dollar. Yeah, that's something that I would like to incorporate, but I don't know. Markov. Yeah. It's spelled Narkov. Okay, so like I'm gonna read you like the straight definition of it, okay? A Markov chain is a stochastic model. So a stochastic model would mean a model dealing with random possibilities, right? Describing a sequence of possible events in which the probability of each event depends only on the state attained in the previous event. Informally, this may be thought of as what happens next depends only on the state of affairs now. So the way that these models kind of work is they say there's some underlying state that we can't see, okay? So what is the probability that we are in this state right now? And if we're in this state right now, then there's a certain probability of us moving into this different state in the next time period, right? So when you start computing through what's the chances that I'm in this state and what's the chances that I've morphed into this state, and there's all of this complicated vector math that you can do to come out, and you basically you get this model that gives you an estimate of which state you're in. Okay, so the common example that they usually use is they say, okay, so let's say that the market has 3 states: trending up, trending down, and range bound, right? Based on current, past prices, what is the chances that we are in an uptrend state? And then you get this Markov system that kind of tells you which state you're most likely in at that time. And then you can use that state thing to say, okay, so when we think we're in this state, then we want to use this strategy. And when we think we're in this state, we want to use this strategy. And then if the Markov model actually does apply there, then that should improve the performance of that system. So that's what a Markov system is about. Markov. Sounds Russian to me. Good morning, Ismail. You're late. And I know that they talk about Markov models in there, so we'll see. But I think the big thing that I'm going to get from that book is like, where does the machine learning stuff actually apply? Because what I've heard is that there's a lot of people trying to just, take a big group of data and slather it against a machine learning model, and then when you try forward testing it doesn't work, right? So the question is, where is the machine learning parts applicable? Overslept? Every once in a while I'll end up being late because I overslept, but usually that just means that I can't shower or eat. So. Man, so yesterday I went to a walk-in orthopedic clinic because my elbow was bothering me. But really the thing that's bothering me the most is my back. I just like when I hurt my neck and it's still sore from it. Oh, you have that book coming today? That's cool. I gotta tell you, man, so I got it yesterday in the mail. I'm just impressed with the book. Like when I saw it on Amazon, I thought that was kind of a boring color and a boring looking book. But when you get it in your hand, it's like this vibrant orange green, and it's just a hefty book. So it's definitely a book that I'm happy to have in my collection. I'm glad that I have a physical copy of it. So one of the nice things about these like really more quantitative books and stuff is you can usually find them online. And they're not cheap books either, right? Oh, that's right. I was trying to look for that post. I never found it. Did you miss anything so far? Yeah, no, there hasn't been any significant market action. There was a little bit of shuffling around in the treasuries on the open, and some seeming changes in the yield curve, but it kind of all ended up being a wash and nothing really moved. So we have a federal Powell will be speaking at 10 o'clock Eastern, or sorry, 12 o'clock Eastern time today. And it's an event that is likely for him to say, you know, significant things. So I expect that the action before that might be pretty difficult. Yeah, 10 tick range in ZN's News Fest. It is, you know, it's really crazy how when ZN goes into range bound mode, how maddeningly tight it really truly is. It's, you know, everybody says, oh, you know, range bound, like you can make money off of the range and everything. Like, yeah, try doing that in ZN. It'll drive you crazy. It's better to just not touch it, man. That's my conclusion after trying all of these many different ways, is that when ZN is not moving, it's best to just leave it alone. Which is why the stream was always kind of useful in the first place in the beginning, was because in 2017 this was like every other day, right? So having people to talk to was really, really helpful. Oh, your time zone is GMT, that's right. Well, I wake up at 5:30 every day, and I usually try to start going to bed at 9:30. Latest I'll ever stay up is 11. I guess last night I didn't really fall asleep until 11. So I didn't get very good sleep last night. But I usually don't notice. 11 is it? Yeah. But let me tell you something. At least for me, few things have done more for my productivity than waking up early. Because I tend to wake up at that time every day anyways now. And it's, you know, nobody else is awake. There's nobody else to bother you, and people are more productive in the mornings. So if it's a Saturday or a holiday and I wake up at that same time, but I'm not streaming and I just work, I get so much stuff. You know, those 2 or 3 hours, you can get a lot done. You can get a lot done. Yeah, unless you get a Discord. Yeah, you get stuck messaging D back and forth for hours. That's why I think I didn't fall asleep until 11, because I was like in bed, and then D found another indicator he was interested in. So I'm trying to talk him out of the indicator. That's really what I'm trying to do. But I sent that over, by the way. He was asking about it at an indicator that looked like price action swings, so I sent him over the one. The one that I sent over, it should have more than one thing on it, right? Because there's like, I'll show you. It did not show. Well, you probably are not finding it. So go to indicators. It's going to pop up, under Poncho, I believe. So there's two indicators in this one. There's price action swing and price action swing oscillator. So price action swing gives you the swings, and it gives you metrics about each swing at each point, right? And then the oscillator kind of gives you, okay, how much volume is trading up until we get to the swing point, and then you can see it goes back down to zero, and now it's red because it's a downswing, and then it goes back to zero, and now it's green, right? So like I said, I think it's really flawed to try and look at each one of these segments and as a data point, and then trying to do your analysis based off of that. I understand why people think that would be useful, but I think that when the inelastic market hypothesis guys, I think kind of really effectively argued against that if it's these underlying flows that matter, you could have a situation where the market is moving up against that flow because there's some counter flow, and so you can't use the swings per se as the starting and ending point of those different meta orders, right? To a 6 range. And this is the other thing, is like that you want the range chart. So I think this one will show you volume and so forth, right? So like, here's the thing, is that you'll be able to get like metrics for like volume, cumulative delta, probably stuff like that. So I don't think that this one does cumulative delta. And like I said, Jigsaw has cumulative delta. Theirs has cumulative delta, rather. But my indicator, where it's like showing you stuff actually on the book, because that information has to be saved to a time series, right? In order for me to do anything with that, I have to have the underlying time series involved, right? And because this range is going to be broken maybe somewhere in between that minute bar, right? How do I split it out, right? So can you control the swings to only plot on orange and blue? You mean like make the candles only be orange or blue? Oh man. See, I'm You can do what you want, but like when I hear that stuff, I'm immediately like, yeah, that's probably not a good way to approach it. I don't know if you can change the coloring of the bars. There's certainly a lot of options for you to change the colors, though, right? You can change the color of the zigzag and stuff like that. Or you can choose to not show the zigzag and only have the text. And you can change the color of the text based on you know, or whether it was a higher high or a lower high or whatever the deal is, right? Interesting. We're at the highs of the day now, huh? Another thing you really got to be aware of with the price action swing thing. So it's showing you right now. So they have a potential swing low, double low, and now it's moving up, right? So if this all of a sudden turns back down and dumps, then what will happen is it will just extend that lower low further down. So like it repaints past bars. Do you want to not include red candles in the swing, only to say take say 3 up bars, then a swing is created as soon as color changes it starts? No, I don't. Okay, the way that this works is there's a swing size, and essentially, in order for you to have a confirmed swing low, it has to pull back from that low at least 7 ticks. So if it's 7 ticks or higher, so if it's like 8 ticks, then I can say that there's a swing high and it can make a new dot, but not until that happens. So until that happens, it's a tentative, right? That's why right now there's a dot down at the low. But if it goes lower, what it's going to do is it's going to redraw all of those bars to show that, oh, actually we were still in a downtrend that whole time, right? So like right now, you don't see it. You just see that there was a swing high and now we're on a downswing right now, right? But there was several points in that downtrend where it came back up significantly, right? And so you would have seen the line would have been like this, and then it'd be coming up, and maybe tentatively you get a new swing high or something like that, right? So the point is like when you look at it, you look at the zigzags and you say, okay, so this was the high and this is the low. This is what I want. I want to see what happened between here and here, between this high and this low. And what I'm saying is the problem is that when that high and that low is created, you don't actually know that it's the high or the low. The indicator redraws after the fact to make the past chart look correct to you. So some of these metrics that you might want to use, right, this is not going to make sense because like again, right now it says 365K, for instance, right? Well, if this pushes down and makes a new low, then that point is going to have to change, and it's not going to be 365 anymore. So I do have one of these on here. I have it on this chart. So why am I using it? The only thing that I care about here is how large were the swings, and I'm using that as a measure of volatility. So if I'm going to come in here and trade the treasuries, I have to realize and account for the fact that there are trends here in the treasuries today that have been almost 16 ticks, right? And that's all I care about is the volatility of it, right? Because what are the parts of the market that we know are useful? Correlation, volatility, order flow, then your risk management and informational inefficiencies. All this other stuff about like it made a higher high and a higher low, and this number was bigger than this number. the volume on this swing was larger than the volume on this swing. The market orders on this move was less than the market orders. It doesn't mean shit. Doesn't. It's just noise. And the trap that I'm afraid that you're gonna fall into is you're gonna see all these little toys. You're gonna want to add every little toy that you can find, instead of focusing on like the things, you know, like the time that you really should be spending is like, you know, reading Zero Hedge or whatever. Yeah, I'm not quite sure I understand why you want it or what you intend to do with it. You haven't been specific enough about why. Like, it seems to me that the only reason you care is because you want these metrics printed out on the chart above the swing high and the swing low, right? But what I'm trying to say is that, like, where that point draws and when it draws is like really important, right? So let me show you something different here. It's gonna take this oscillator off. Change the colors of all these so you can see better. Right. Apply. Okay, so now it's only showing you the swing and how big the swing was, right? Where that point draws shouldn't be important at all. Did you catch what I was saying? Wait, this will get into the same question. Okay, so now I have this other indicator that I wrote for somebody a long time ago. It's called price pivots. Okay. Oh wait, how am I doing this? I do have it draw these other things, don't I? Is price action swing ruining it? Oh, you know what? It is probably that it doesn't like that it's a... I don't remember how to make this one work the way that I want it to. Maybe if I put the other version of it on here. Nah, that just gives me a distribution profile. That's not it either. Oh no, those are just the subplots. How did I freaking do it? I think I broke the indicator. Unless I have it somewhere down here. No, I don't think so. Yeah. His overlay, true. Drawn price panel, true. This whole thing right here, transparent. You have any experience trading commodities? Well, I mean, I think it's a very similar to trading the interest rate futures, but you can think of a treasury as a commodity, right? It's like so in oil, you have like the oil inventories and like production, right? The equivalent of that in the treasuries is like the auctions when they say how much they're actually going to auction. Right, that's the supply coming out, and then you have to look at like, you know, how much was used and stuff like that. So it's kind of a similar thing. It's just you have to apply it to. You just have to apply it to what you're doing. Oh, I don't want to do that. I want to remove the other one. Dun, 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 dun. Let's see if that does it. Fingers crossed. Yes. Okay. Much better. And back over to here to this one. We have to switch this all up again. False. Make them all white. Make all the text white. Okay. Very good. Yes. Okay, so now I can show you what I want to tell you. Okay. So this zigzag that you see right here. This is determined by, has it come back more than 7 ticks, essentially. It needs to come back more than 7 ticks for it to start drawing a different circle, right? And then again, like if it starts going up and then it doesn't continue, then it will say, oh, okay, that wasn't actually it, so I'm going to move it, right? Okay, so it redraws, essentially. So my indicator is a pivot. What's a pivot? Well, a pivot says that you don't have a swing high or a swing low until you have a bar that closes below the previous bar's high or low, right? So if I go back to the beginning of this chart right here, for instance, you can see there's a little triangle underneath of this one. So that is where it says it was the pivot. But it's not until 2 bars later where you see the circle that the pivot is confirmed, because now you have it where this bar closes above the previous bar's high, right? And that's where it determines where the pivots are. And then it will draw a little line that will continue through up until the point that that is broken, right? So the idea is that they'll tend to retrace until they come to those pivots. So like if we come through back down through here, they're going to probably try and go through all of these and whatnot, right? So the point was, how do you determine where and what you draw when you're trying to determine what's the high and the low? You can look at it and you can say, oh, okay, this is the low and this was the high. But you can see that actually like setting that quantitatively is actually like not a simple thing, right? And the only reason that you can do it so easily is because you're not actually following any strict rules. You're just kind of arbitrarily deciding what made the most sense to you that day. Right? Too big brain for me. Yeah, it is. It is too big brain. Like that's the whole thing about it, is that this indicator, man, holy shit. Okay, I wrote this. This is good, clean code. Okay, it's like 1,000 lines. And I have a lot of stuff that a lot of features, you know, like canceled out and stuff. But look at this on bar update, right? The on bar update is almost 300 lines, 200 lines. And like, look at all of the if statements and shit in there. It's freaking complicated. And I can't tell you how many times we had to go through. It was like, oh, okay, it should be drawing this, and it should actually be drawing this and this and this. Like, the logic to make these kinds of indicators are nuts. Okay, well, come back and look at Poncho's, his price action swing. Like, holy shit, dude, it's like 3,000 lines of code. You kidding me? It's nuts. That's not even the, where is the, oh, here's the on bar update. The on bar update actually uses these other things. Calculate swing ticks. Like, look at the convoluted logic on that. It's ridiculous. If I was to write price action swing from scratch, I think it might be, I'm not going to do any hard math, but I think that it might be $3,000 to $5,000 to write it. The fact that Poncho put this out for free is actually really quite impressive, because it's really, I mean, now I don't think that programming is like his primary thing, or at least it wasn't when he wrote this, because some of this code is really hard to follow. But you know, when you get all of these things where it's like if nested inside of if, and you've got like 5 levels of if statements, there might be something wrong with your logic, right? And that is all for what? To decide where you decide that there's a swing high and a swing low, right? So I'm just saying, like, if you're putting some sort of cumulative delta indicator out there because you want to see what was when we were up here, what did the book look like when we were up here, for instance, because that's what it sounds to me like you want to do, D, right? Where it draws kinds of matters, right? But it kind of doesn't matter. I mean, you're going to get a completely different value based on whether it draws it here or here, right? So really, if you get a different value here and a completely different value here, then is the thing that it's printing out to you actually useful or tell you anything? I don't think it does. But that's a swing indicator. Zigzags are a nightmare. So part of the thing about the price action, or sorry, the pivots indicator, was that now I can come in and I can say, okay, so like here's the last swing. Is this swing low equal to this swing low? Now you can kind of do this sort of like higher high, higher low sort of analysis, the price action setups that people talk about. But when you do it with the pivots version of it, you have an indicator that doesn't redraw, so you can actually like back test it, right? And so this was how I was able to back test certain price action strategies to find out that, oh, the only reason that people think that the price action works is because they're holding such a large stop. So that's what that was all about. That's why I put so much effort into it. And I have all of these, I have all this stuff in it for you to be able to draw, to be able to read it from an indicator, or sorry, read it from a strategy rather. I'm gonna close this chart now because it makes me upset thinking about it. Because it was so hard to write, and in the end I really feel like it was a waste of time. Oh yeah, I didn't like that. It looks like it found some problems in there. The fact that you guys are relatively quiet on it means that you didn't care too much for it anyways. Because they're like, oh, he's explaining to us how an indicator works, but we know that he thinks the indicator is bullshit. Yeah. Pretty much. Well, it's not bullshit. I mean, it was useful to be able to disprove certain things. So it's kind of useful from the perspective of how do we solve this problem? Because the price action people seem to think that you can't actually program it. No, you can. It's really advanced. What would you disapprove with it? So I think that the what it really comes down to is this. Hold on a second. Where's my new? Oh, come on. I swear I had one. I can't see it. Where is it? Where's my pen? I had another pen. Not that one. Oh geez, what was it even called? G ink. There it is. There it is. See if I can get this to work. There we go. Nah, this one. Okay. So if we have a function c of t equals y, okay, so t is the time and y is the price, okay, f of t minus 1 does not tell you anything about y. It tells you very little, if anything, about y. The only thing that I can really say about y2 is that y2 is 80% chance of being within a certain number of points of y based on the volatility of that instrument. This is going to be fat-tailed. So it's going to be so close, and if it's not, it's going to be like really far away. That's the only thing I can tell you about y from y2. So if y is like the next bar, and y2 is the bar that we just had, this bar that we just had isn't going to tell you anything about this future bar. Like that's just the way that these work. It's a martingale. Okay, so this doesn't give you any probability of predicting this future thing, is what it comes down to. So any strategy that is based on trying to look at the series f of t and all of the values on it and trying to do some sort of analysis on it is useless. That's really what it comes down to. Okay, so how do you deal with this problem? Because the people will say, well, then how do quantitative strategies work? How do algorithmic strategies work? Well, I'll tell you how they work, is that they have other data series. You're going to have the G of t, and you're going to have, which it would be like the order flow, and you're going to have like H of t, which would be this other instrument at that time, and you're going to have you know, some fundamental data point like what the non-farms jobs payrolls were at this point, right? And now that you have multiple data series, you can look at like the most recent data, and you might be able to find some situations where you can predict what f of t is actually going to be. Okay, I have no clue what you're talking about, actually. So that's kind of how you work these things out. So going back to what are the elements that we know are useful and effective for us, right? Correlated instruments, the order flow, volatility, right? Which is the one thing that I talked about here, is that we can say that f of t is going to be so far within a certain amount. Okay. And then you have to practice risk management and find informational inefficiencies, right? That's basically all you're left with, right? So informational inefficiencies would be like, is basically finding other data series to incorporate into your strategy to try and predict what f of t is going to be, right? But just looking at the data series, this one single time price series is useless. It doesn't tell you anything. As all retail traders do, is they just look at that, and it's a waste of time. And then every time that somebody wants to come in, some people just have a hard time explaining what they're trying to do and everything. But usually what people want me to do when they want me to write something is they want me to do something that will do more analysis on that with single time price series. Not interesting. All right. So that's why I disapprove of it, of price action swing. That it was like a the swing high was higher than the previous swing high doesn't mean anything. That's Dow theory applied to daily, so there might be some efficacy to that, but on intraday charts it's useless. Oh, I need to change back to my regular cursor. I think this G ink is okay. I like how when it comes out, you get like 3 different pens, and you can change like the size and properties of them and so forth. I'm seeing your messages, but you know, you're not actually telling me what it is that you want, so I can't. All I can do is be frustrated because I don't want to do it. All I can focus on is that it involves the zigzag in some form, right? The other one was interesting because it was a different way of showing my like existing data in a way. So here's the other side of it though, is that when you move away from something that is time-based, you introduce all sorts of problems. Problems both in not only in being able to actually like program it, but problems in like the analysis of it and so forth, right? Like a strategy that is built on range bars usually does not translate to live. You'll get all of these things where, especially line break ones, if you use line break bars, you know, those always seem to backtest really, really amazingly well. But when you actually run the algorithm, it doesn't work. It just fails hard every time, right? Time is the most, we want to say, like, indiscriminate. It doesn't care what time it is, right? Whether a move started at 8:26 or 8:27, it's perfectly random in that respect, right? When you start to say, well, we moved 8 ticks, and so now I want a new bar. Now what you've done is you've changed the granularity of your chart based on the volatility, which might make the chart look good, but introduces a bias into any kind of algorithm that you're doing, because the point at which you do the calculation is really key, right? And that's kind of like the whole thing is that if we're using the swings to say, hey, here is what the book pressure looked like, or here's what the market depth looked like at this point, the point at which you show it, you know, is pretty key. Because if I do it on this bar versus this bar, you're going to get a completely different answer. But it is. You're saying what you want, if I understand correctly, is you want where the zigzag points are, it to spit out certain information, right? You want a zigzag, but with a different piece of information being printed out. Yeah, well, because you want metrics to be drawn on the actual chart. Spending a lot of time here at 4113. Yeah. Can you believe that it's only been a 12-point range in the S&P 500 so far for the first hour? That's nuts. That's super crazy, man. That's possibly the tightest open I've ever seen in ES. Well, not ever seen, but certainly like in the past year. So it's a pretty extreme relative contraction in volatility. I don't know which ones. I'm not too familiar with the statistical properties of different types of markets. Right. So what? You want it to print every 3 candles that every 3 candles if there are 3 candles contiguously up? No, but the key thing that you have to decide is, when does it draw? Right? Why does it draw where it draws? Does it draw every, you know? So normally what you do is you just draw the metrics every bar. right? Just the thing that we built already does, right? So it just prints out those values every bar, right? But it sounds to me like you're saying that getting those metrics every bar is too much. So why is it every two? Checking out Twitter here. Really, the more useful question is weekend reading. You gonna give me stuff about martingales? Stochastic calculus. I'm actually a little familiar with some of this stuff. Yeah, see, this is a thing with martingales is like, okay, so like if we just come here. Okay, so when you look at a martingale in probability theory, a martingale is a sequence of random variables for which, at a particular time, the conditional expectation of the next value in the sequence is equal to the present value regardless of all prior values. So it basically, I don't think I completely understand all of the implications of the math to that. But as far as I understand it, it means that this data point doesn't really tell you much about the next data point. Right? That's what I understood it to mean. So when you get into stochastic calculus and stuff like this, I think that there's actual mathematical consequences of that you can get into that I don't understand. So I have this other book that has all of this stuff into it, and that's on the list. I don't know if I'll ever get to that one. Mm-hmm. At 5:34 Eastern. So 3:34 until there was 2 red candles. Okay, so you're talking about these 2 candles right here, right? So to give you an example how that's interpreted, your wiki article equal probability. So heads tails equals tails heads in a 2 coin toss. Okay. No, but it's not just measuring the data though. Why did you pick those 2 candles? What is it about those 2 candles that's like a good example of something, right? Why don't we pick these 2 candles right here? Just the last 2 candles, right? Or like to go back further, what if we just said every 2 candles we did this and then we printed out a metric, right? Okay, cool. But guess what? What if we did these 2 candles instead? You're going to get a completely different answer, right? Yeah, so you're picking the same color. So you're saying if I have 2 or more consecutive bars the same color. Okay, wait, what are you saying here actually? To give an example of how that is interpreted, your wiki article equal probability. So heads, tails equals tail heads and 2 coin costs. So probability is 1/3 of a second coin yielding each possible state instead of 1/4. That I did not understand what you're saying at all. Isn't the probability of it 1/2 times 1/2? But you're saying that a coin toss is not a martingale, right? Is that what you're saying? Right, equals 1/4. So let me see if I oh, but if heads, tails, okay, so yeah, you're getting into like the possibilities are tails, 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 heads, the heads, tails, head, head, and you're saying that the probability of getting this particular outcome, if these two are the same, it's equal to 1/3. I gotcha. Because there's actually only 3 options. But it's still random between those 3 options. If the sequence of the events doesn't matter. Okay, I'm with you so far. Okay, so what does that tell us about martingales? Implying a lowest randomness could be a non-existing left tail. Well, so back up a second actually, because I think the reason you brought it up was because I kind of used the word martingale in a context that it doesn't where it didn't necessarily belong. So what I'm getting at is where does the martingale aspect matter in respect to that particular thing, right? Because all I'm trying to say is that from where we're at right now, if you're trying to predict what the next bar is, the best guess that you can possibly give is the current price, because you don't really have any of the data that's actually going to determine what that next price is, right? So with the data that you have, all you can say is it's going to be nothing's going to happen. It's like, but where I come back to is just that trying to do this statistical analysis on this series doesn't really yield very much for you. Is really the point that I was trying to make. That as far as we can tell, we've tried all sorts of different forms of analysis. Looking at all of this does not do a very good job of predicting what the next candle is going to be, or saying I should buy here and sell here and all that stuff. Once you get a large enough data set, it just comes out to be random. The market is statistically efficient. That was the only point I was trying to make. That semi-martingale system is essentially trending to infinity, which our market is, irrespective of what you guess up as the answer. Well, okay. So what you're saying is that, oh, okay. Maybe. I think that martingales does factor into that, but probably using the term martingale is probably not the best way to try and explain that, huh? I mean, they're adjacent subjects, right? Your PhD thesis is on this? Okay. But I do think you're right that like the best answer is if we're going on the longest time frame is to buy, right? That's why the most sensible strategy is to just buy and hold. They're almost always on your mind. I wish I understood why. So the whole thing is, so let's go back to this, okay? Let me go back to why I say that, or where I'm getting that, because I know that I don't understand it completely. So we'll read the piece of where I was kind of picking that up. Find it here. Oops. There we go. Bachelier's main arguments were as follows. Since each transaction in a financial market involves both a buyer and seller at each instant in time, the number of people who think that the price is going to rise balances the number of people who think that price is going to fall. Therefore, argues Bachelier, future price changes are de facto unpredictable. In more technical language, prices are martingales. The best estimate of tomorrow's price is today's price. A simple example which Bachelier had in mind is when price changes are independent, identically distributed random variables with just zero mean. Let me read that again. A simple example which Bachelier, am I saying his name correct? Bachelier had in mind is when price changes are independently identically distributed random variables with zero mean. Bachelier also noted that due to the central limit theorem, aggregate price changes over a given time period should be Gaussian random variables because they consist of a very large number of small price changes resulting from individual transactions. So that's where I was getting that from. Like, right. In other words, to me, the assertion that prices are that prices are martingales, it basically means that you really can't predict it. Bachelier Okay, maybe we should just call him Big B or something. I don't know. The Big B, yeah. Yep, that's what equal probability at each step implies. Okay. So my application to this, what I was trying to say is, because prices are martingales, f of t minus 1 tells you almost nothing about what f of t is. F of t meaning the end of the current bar, the end of the next bar. The current bar that's currently forming. What the end of the bar before it was tells you nothing about what this bar is going to be. Yes and no. I'm familiar with that bit. It's interesting to me. Like, here's my understanding of Bachelier's work was that he was trying to predict the financial markets, and his basic conclusion that he made and what he was trying to do is like doesn't really actually work. That he was just like dead wrong, but the math that he made to trying to figure it out became like the basis for everything else that came after it. Isn't that kind of the way that it worked out? Was like he never made any money from the market with it and everything, but then there's this whole branch of math and study of markets that was kind of based on his work. Yeah, his basic conclusion is pretty much what Black-Scholes Merton came to, actually. There you go. Anyways, this whole thing is I think is essential, right? Because okay, so if you're going to do something quantitative, right? If you're going to do something like, think about it from a quantitative perspective. I'm going to make a strategy that tries to predict future prices. If f of t, if the last bar doesn't tell me anything about the next bar with any real efficacy, because prices are martingales, then what do? The only piece of information that you have in here is ineffective. So how do people have quantitative strategies? Well, I'll tell you how. They bring in other information. There's more than just there's more than just T and Y. There's more than just what price it was at this time. There's a whole universe of probably literally trillions of different data series that you could potentially incorporate into your strategy to try and make an effective strategy. And retail traders put all of their focus on the one piece of information, the one time series that the mathematicians have basically said by its very nature can't be predicted. Like, that's the only way that I can explain it. Right. Well, I mean, and so first I started to say, okay, this is why it doesn't work. Like, why are prices martingales? Well, because anytime that somebody notices an inefficiency in the market, they arbitrage it out. And there could be some behaviors that are more persistent because they're created by the structure of the market, but it's going to be very competitive for you to get those. Retail trader, you're probably not going to be able to get those, right? People don't understand that. So then we're going down this different road, which is like, okay, so what do we actually know? What can we actually use? What are some of these other data series that we can bring in? Correlated assets, the stylized behavior volatility, stylized behavior of order flow. And then of course, just as part of your those are like the extra data, and then informational inefficiencies, which could be fundamental data, it could be information about other people's positions. It's just anything that's not generated by the market itself is how I would explain it. And then on top of that, you need to practice risk management, right? That's your strategy. Just make friends with this. There you go. Well, as long as he's not actually giving you inside information. If you're friends with the CEO and he seems like he's in particularly good spirits this week, and so you decide to buy the stock, I think that's legit. I think you can do that. As long as he didn't give you inside information, I think you're okay. I would be really careful because you're probably, if you're too good, it's probably going to be suspicious, but I think you can trade on that, can't you? And if the regulators ask what the fuck, tell them you're making the market more efficient by pricing in the average. Well, I mean, you have to explain how you knew that, what was the basis of the trade, essentially, and show. I don't know how you would show, but you would have to say I didn't have any inside information, right? It's not even. You know what? I tell you what, they play games with you with this, guys, right? There's the definition of what is non-public information. That's really what it is you're not allowed to trade on non-public information, right? You can trade on inside information kind of to some extent, right? So for instance, if I'm a farmer and my crop is not yielding very well this year, then I can go and buy the futures knowing that the crop is going to be bad, right? To hedge myself against the loss of my crop. Right? I'm trading on inside information, but it's not non-public information, right? Non-public information would be information that has been specifically selected by the SEC as information that the public doesn't have that would be relevant to the stock price, and has to be distributed to the public in the form of, 8K statements and stuff like that, right? So this is how Congress kind of gets the end run around you, is that they'll know something that's going on in Congress and they can trade on it. How can they trade on it? Because the information that they're trading on is not non-public information. In fact, it's public information. It's public information that not everybody has yet, right? So yeah, can you find pieces of information that not everybody in the market has? And yes, you can. Yes, you can. And it's actually much more available than you think, because there's all sorts of information that is just like laying out there on the internet, frankly, that I guess you could consider public information, but it's not factored into markets. I think that's the best way to trade, is if you can have a piece of information like that. That's always going to be better. That you have something that gives you a really high probability of knowing where we're going to go from here. Like this would be considered non-public information, okay? But if you knew what Powell was going to say at his thing today, like you had a copy of his speech ahead of time or something like that, okay, do you know 100% what it's going to do? Not exactly, but you can predict with almost like 90% probability what's going to happen, right? That's always going to beat out this chart nonsense that everybody's talking about. It was revealed to me in the dreams. Something irrational longer than being, yeah. Well, I again, I think the issue there is that there are so many different things that drive order flows, and that's where it gets kind of interesting, is that the professional world is well aware of the fact that prices are martingales, I guess you could say, or that prices are by their very nature difficult to predict. And so their approach has been, well, okay, so all of this technical stuff doesn't matter. I'm just going to use fundamentals. And then the market doesn't do what the fundamentals should suggest, right? Because what they're not factoring in is all of the information out there that is going to affect the supply and demand in the stock that have nothing to do with fundamentals. Like this past week, like the S&P 500 has held these prices really well. Like that the S&P 500 is still over 4,100 is quite surprising to me, given last Friday's move and everything. Why is that? Well, I mean, like we got Powell speaking, and then next week on Tuesday, so a week from today, we're gonna have CPI, right? So like, what happens if you go outright short the market here, and then Powell says something dovish, or the CPI ends up being good again, which I think is probably more likely than the scenario where it's bad. Then you're going to be screwed, right? So here we have this piece of information that kind of suggests to us that the Federal Reserve is going to have to be more aggressive, but tactically speaking, it doesn't really make sense to try and go short the market here at this point yet, right? So right now, I think you have an example. You have a good example of the higher interest rates isn't being properly priced by the markets, in my opinion. Surely the random niche bits of information that aren't factored in are meaningless against bigger catalysts. Well, so this is the thing that I think is really staggering about it, is that sometimes those bits of information that you have are things that can tell you what's going to happen with the bigger catalysts. Like that's the like the one that I talked about is probably like the biggest thing in the markets right now. Like think about that, what I just said. The biggest, most consequential piece of information that we've maybe received all month, and I'm saying that the markets aren't properly pricing it in. Like, how crazy is that? Right? You're not always, the problem is just that it's like it changed, you know, the situation changes with each individual piece of information that you get. How is order flow different? Okay, so this is a good question. I wish I had more time to answer your question, Yassine. So the stylized behaviors of order flow are really well established. So there are some particular behaviors in order flow in the way that it tends to behave that are very, very consistent. And what happens is the market makers know this, and they have to account for it by randomizing their price in consequence of it. So they might know that there's more market buy orders than market sell orders coming into the market this day, but they have to, you know, pull their bids sometimes because, you know, they won't be able to make money if price just goes in a straight line. They need it to be random. So that's why price kind of ends up looking random, but you can actually find these statistical aberrations in order flow. That being said, it's a little bit too simple to say, oh, here's what I can see that there's more market buys than market sells, so I should just buy. It's going to be more, it's more complicated than that, because there's still kind of a fat-tailed nature to it, which is that when those order flows change, it's going to happen very quickly. And those sell orders, if there starts to be more sell orders, those sell orders are going to have more impact, and it's going to move price down more. So you kind of have to be able to predict the orders before they come and know like why that flow might shift. But then if you're predicting that correctly, you should see the actual flow as it comes in, because if you're correct, then that stylized behavior will appear, right? And that's why analyzing price isn't really very useful to you. Analyzing order flow is very useful to you, but analyzing order flow is not enough. You still need to have predictors of order flow. You still need to have those informational inefficiencies. I digress. I gotta get going, guys. I'll see you tomorrow. In the meantime, stay excellent, team. No, I don't. I got the wrong cursor. See ya. I'll still be in Discord. This in an hour is going to be interesting.